Okay, so essentially the financial statements provide a snapshot of an entity at a particular period of time. We can use these as a measurement or a guide to where a business is currently at. However, many are left feeling perplexed by the interrelation of the financial statements. So this video will serve as a demonstration of how the four financial statements interweave with one another. Firstly, the statement of comprehensive income is revenue, which is inflows, minus expenses, which is outflows, equals net profit or loss. Now this interrelates with the statement of changes in equity, which demonstrates that retained earnings needs to incorporate an plus or minus net profit and loss. So this retained earnings or beginning balance, plus or minus net profit or loss, also included with minusing dividends or drawings, gives us our retained earnings at the end of the corresponding period or our ending balance. Now this statement here, the statement of changes in equity, also interrelates with the statement of financial position or the balance sheet. Now the balance sheet demonstrates assets are equal to liabilities plus owner's equity or retained earnings. Assets include current assets and non-current assets. Liabilities include liabilities current and non-current. And in the equity, this is where we interrelate our statement with the statement of changes in equity. Now retained earnings is the equity here. So once we incorporate the ending balance of the statement of changes in equity for the period, we include that in the statement of financial position. Now, in the fourth statement, the cash flow statement, we are able to see if a business is profitable, but also able to provide funding for its shortfalls of cash. This is because the statement of cash flow helps us assess if a company can satisfy its bills. So, as the statement shows, cash flow statements equals operating activities plus or minus investing activities plus or minus financing activities. This then incorporates the cash balance from the asset account in the statement of financial position or the balance sheet. This is important because it shows whilst the business may be profitable, it also shows the ability of the business to satisfy its debts. Whilst the statements provided can often be confusing or perplexing, these four statements interrelate quite efficiently, and I hope this has been an effective display of their relation.